In many developed countries in the early 21st century, daily life is marked by a persistent feeling that basic existence has become harder to afford, even as salaries, technologies, and economic output have grown. Rent, food, transport, and services consume a larger share of household income, while financial security feels increasingly fragile. This sense of pressure is not the result of a single dramatic event, but of several long-running shifts that have quietly reshaped how money flows through modern life. Number 1. The first major factor involves workers whose wages have not kept pace with the rising cost of essentials. Since the late 20th century, especially from the 1980s through the 2020s, average wages in many developed economies have grown more slowly than the combined costs of housing, food, energy, healthcare, and education. In nominal terms, paychecks often look larger than those of previous generations, but once inflation and living costs are taken into account, the real purchasing power of each unit of currency has frequently stagnated or even declined for large parts of the population. This divergence is significant because it erodes the foundation of financial stability, as even full-time workers can struggle to cover basic needs, leaving less room for saving, investing, or weathering emergencies. The immediate consequence is that a growing share of income is consumed by non-negotiable bills, while long-term effects include weaker household balance sheets, increased dependence on credit, and a sense that hard work does not reliably translate into improved living standards. Number 2. Another central factor is the transformation of housing from primarily shelter into a prized financial asset. From the 1980s onward, real estate in many urban and suburban areas has been increasingly treated as an investment vehicle, influenced by easier mortgage credit, financial deregulation, speculative buying, and, in some places, short-term rental platforms that convert homes into tourism properties. Over the decades leading into the 2000s and 2010s, this shift contributed to steep increases in home prices relative to average income, particularly in major cities. The significance of this change lies in how it reshapes the path into stable housing, as renting consumes a larger share of income, while buying often requires much higher down payments and exposes households to decades of heavy debt. In the short term, families face crowded rental markets and competition not only from other residents but also from investors and developers, while over the longer term, elevated housing costs contribute to delayed household formation, geographic inequality between property owners and non-owners, and a persistent sense that safe, stable housing has become less a basic expectation and more a high-stakes financial achievement. Number 3. A further pressure comes from the changing cost and character of groceries and everyday consumer goods. Since the early 2000s, and especially after the global financial crisis of 2008 and the supply chain disruptions of the early 2020s, food prices have been influenced by energy costs, transportation constraints, climate shocks, and labor expenses. Beyond straightforward price inflation, two related practices have become common in many markets. The first, often called shrinkflation, occurs when manufacturers reduce package sizes or quantities while keeping the sticker price similar, so the price per unit quietly rises. The second, sometimes described as skimpflation, involves reducing product quality or service levels while maintaining or increasing prices. These trends are significant because they obscure the true rate at which household costs are increasing, particularly for lower-income families that spend a larger share of their income on food. The immediate effect is that familiar shopping baskets cost more while containing less, forcing adjustments in diet and purchasing habits, and over time, this contributes to heightened food insecurity, stress over budgeting, and a perception that money no longer stretches as far in the most basic areas of life. Number 4. The spread of subscription-based business models has turned many one-off purchases into ongoing financial commitments. From the early 2000s through the 2020s, media, software, and services shifted heavily toward recurring payments. As streaming platforms replaced video rentals, software licenses moved to monthly or annual fees, and digital services such as cloud storage, fitness applications, and game libraries adopted subscription models. A subscription is an arrangement in which a consumer pays regularly, often monthly, to retain access to content or services that cease immediately if payment stops. This development is significant because it changes the cost structure of everyday consumption, as expenses that were once irregular or optional become continuous, predictable debits from bank accounts. In the short term, each individual subscription appears modest, but the accumulation of many such charges can quietly absorb a substantial portion of disposable income. And over the longer term, the normalization of recurring payments makes it easier for both companies and consumers to underestimate the true lifetime cost of digital lifestyles, leading to tighter budgets and less financial flexibility. Number 5. A less visible but pervasive influence is the spread of hidden fees and ancillary charges layered onto advertised prices. From the 1990s onward, sectors such as air travel, ticketing, hospitality, and banking increasingly relied on additional fees, including baggage charges and seat selection fees on flights, service and convenience fees on concert tickets, resort fees at hotels, and various account and overdraft fees in financial services. These charges are often not fully apparent until the final stages of a purchase or appear in fine print rather than in headline prices. The significance of this practice rests in how it distorts consumer understanding of true costs, making comparison shopping and budgeting more difficult. Immediately, the final amount paid at checkout frequently exceeds the price that initially attracted the buyer, creating a sense of unpredictability and frustration. And over time, pervasive surcharges contribute to mistrust in institutions, normalize opaque pricing, and ensure that the effective cost of participation in modern life exceeds what official price tags suggest. Number 6. Another deep structural change is the gradual transfer of financial risk from large institutions to individuals. From the late 20th century through the early 21st, many employers in developed countries shifted from defined benefit pensions in which companies guaranteed a set retirement income to defined contribution plans, in which workers must manage their own retirement investments. At the same time, higher education costs in numerous countries grew significantly, leading to increased reliance on student loans. While in healthcare systems with private or mixed funding, insurance deductibles, premiums, and out-of-pocket expenses have often risen. This reallocation of risk is significant because it transforms long-term security into a personal financial project that depends heavily on markets, policy decisions, and individual choices. In the short term, households must divert more income towards savings, insurance, loan payments, and precautionary funds, leaving less for daily consumption. And over the longer term, outcomes become more unequal, with some individuals navigating these systems successfully while others face heavy debts, underfunded retirements, or medical financial strain, reinforcing the impression that modern life requires constant financial defense. Number 7. Cultural expectations surrounding what constitutes a normal or acceptable lifestyle have also escalated, particularly under the influence of digital media. Since the late 2000s, social networks, influencer culture, and image-focused platforms broadcast highly curated versions of everyday life, often emphasizing travel, fashion, home decor, and frequent consumption. These platforms are digital services where individuals share photos, videos, and updates with large audiences, shaping perceptions of what others own and experience. This shift is significant because it subtly raises the perceived baseline of success and comfort, as modest or slower-paced lifestyles become less visible and less aspirational. In the immediate term, many households respond to these pressures by spending more on dining out, entertainment, gadgets, vehicles, and housing aesthetics in order to match perceived social norms. And over the longer term, these expectations fuel lifestyle inflation, a process where expenses increase as incomes rise, preventing corresponding growth in savings or financial resilience and reinforcing the sense that no level of income is quite enough. Number 8. A final important factor is the strain on public services and the resulting growth of private workarounds. Over several decades, particularly from the 1980s onward, many regions experienced underinvestment or stagnation in areas such as public transportation, education systems, affordable housing programs, and certain parts of healthcare infrastructure. When public options become overcrowded, unreliable, or geographically uneven, families with sufficient means often turn to private alternatives, such as private schools, tutoring services, private clinics, personal vehicles instead of buses or trains, and home security systems in place of reliance on local policing alone. The significance of this trend lies in how it effectively adds a second layer of cost for access to safety, mobility, and opportunity that were once more widely provided through collective funding. In the short term, households that seek higher quality or more predictable services take on additional recurring expenses, and over the